Hello everyone, my name is Nur Shahida binti Abdul Majid and these are my group members. So our group decided to choose transportation and logistic industry and the chosen company are Gunung Capital Berhad, PDZ Holdings Berhad and Transocean Holdings Berhad.
Hi, my name is Dile Naitika and I'm going to talk about Gunung Capital Berhad. So Gunung Capital Berhad is a public company listed on the main board of Kuala Lumpur Stock Exchange which stake in more than 20 companies from various sectors across the country. Prior to the end of 2010, GCAP was principally involved in the trading of latex concentrate. In the year of 2010, GCAP acquired GPB Corporation Sdn Bhd, which primarily chartered its fleet of land-based passenger transportation assets and specialty vehicles. Later on, in 2013, GCAP ventured into the renewable energy sector by acquiring Perak Hydro Renewable Energy Corporation Sdn Bhd.
Hi, my name is Obelo and I will share the PDZ Holdings Berhad company. So PDZ Holdings Berhad is a Malaysian-based investment holding company. The company and its subsidiaries are engaged in the ship and provisions of related service, provisions of administrative and support service activities, transportation and warehousing.
Founded in 1977, Transocean Group is a leading transport and logistic company in Malaysia and provides added value services in the areas of road transport, air and sea freight, warehousing, logistic and custom, and forwarding services from the Malaysia to Singapore and Malaysia to Thailand routes.
The first item is property, plant and equipment. The item decreased from the year 2018 to 2020. Depreciation reduces the value of property, plant and equipment on the balance sheet as the value of asset is lower over time due to wear and tear and the reduction of their useful life. The second item is goodwill on consolidation. The increase from 2018 to 2019 is because the parent company gains control over another subsidiary company and is recognized as an asset in the statement of financial position. The decrease from 2019 to 2020 is because goodwill impairment occurs when a company decides to pay more than book value for the acquisition of an asset and then the value of that asset declines. The third item is trade and other receivable. There is downtrend in the figure from 2018 to 2020. The company has high level of receivable in relation to its cash on hand. This often indicates test business practice in collecting its debt. The fourth item is cash and cash equivalent. They are decreased from 2018 to 2019 and increased in the 2020. The cash is reduced by the payment of amount owed to a company vendors, to banking institution, or to the government for past transactions or events.
So the most significant changes in PDZ's financial position that I have analyzed is the first item, we have net fixed asset from 2018 to 2019, just a small increase, but in 2020 the net fixed asset increased drastically, almost by 15% compared to 2019. The reason is the PDZ acquired investment in Associate and has subscribed for 40% equity interest of EC Victory Sdn Bhd for transportation and warehousing, which causes of increase in net fixed asset. The next item is trade receivable. Only small increase from 2018 to 2019 by less than 1%, but during 2020 it drops roughly to 1.11%, which is more than 5% of changes. This means that the company managed to collect the payment from its customer quite well in the year of 2020 compared to 2018 and 19. A tiny increase in 2019 because PDZ are not getting payment for invoice in fast enough. Referring to the tax payable in 2018 and 2019, PDZ Holdings has not having any tax payable, but in 2020, the tax payable is amounted 67 million ringgit that contribute to 0.11% of addition in tax payable. It might be the company has owed income taxes or property taxes in 2020, maybe comes from the addition of investment in associate in non-current assets. The second last item is the share capital. in 2018, it increased by around 5% to 2019, and then rises more in 2020 for more than 31%. This means that the company raises money by issuing either common or preferred stock. The amount of share capital or equity financing a company has can change over time with additional public offerings. Lastly is the accumulated losses, known as a negative retained earning. So the company retained earning has fallen significantly every year for 3 years. More losses in 2019 with difference of around 19% compared to 2018. Furthermore, the losses got much higher by more than 29% in 2020. This is because the company has significantly decreased in their net profit. Okay, enough for the vertical analysis of financial position.
The first item we are going to evaluate is property, plant and equipment. PP&E are long-term asset that is crucial to business operation and the long-term financial health of a company. As we can see, the item increased every year from 2019 to 2020. This is because if you look at the annual report, Transocean increased the cost of spending for the warehouse machinery and equipment for about 10 to 20% in order for it to expand its business. Next is the trade and receivable. Trade and receivable are defined as the amount owed to a business by its customer following the sales of goods or services on credit. For Transocean, this item increased every year. This means Transocean Finance Department isn't competitive with its term and Transocean's clients has a low proportion of quality customers that pay their debts quickly. The next item is lease liability. A lease liability is the financial obligation for the payment required by a lease. So the increase in lease liability for Transocean is probably caused by the increase in interest rate for the lease. Last but not least is the share capital. So the percentage of the share capital increased from the year 2018 to 2020. This shows that Transocean might sell additional shares of stocks to finance additional company growth.
Now, let's see the overall comparative analysis of all the three companies for horizontal analysis of financial performance. The first item is the revenue. So based on the graph, Gunung Capital Berhad, the revenue trend is inclining from 2016 to 2017 and declining from 2017 to 2020. The reason for the incline trend is because of the expansion of the business. In the year 2017 to 2020, the decline in revenue was mainly due to the revenue contraction from the transportation segment. The transportation segment has been the sole revenue contributor to the company. And then looking to the PDZ's revenue, it shows a declining trend from 2016 to 2018 and just a bit of incline in 2019, and it continued to decline until 2020. The decline in revenue might be the arrangement and the quality in goods and services is not good. In 2019, the tiny increase in revenue, but in 2020 might be because of the pandemic lockdown that led to a decrease in revenue, maybe due to the low demand for fridge during lockdown and cannot operate business efficiently. Next is the Transocean revenue, shows a consistency but in declining trend from 2016 until 2020. In 2020, the revenue decreased but not less than 50% from base year 2016. The reason was because of the long lockdown in Malaysia and Singapore. These are the routes that the transportation and logistics will go through, hence when the two countries keep dragging the lockdown period, it greatly affected the company sales and revenue. The second item is cost of goods sold. Based on the trend for Gunung Capital Berhad, the overall trend for the item is declining from 2016 to 2019. Even though there is a little incline from 2019 to 2020, the reason for the declining trend is because the company started buying materials in bulk and they get discount from the same supplier for production. while PDZ Holdings Berhad cost of goods sold shows a declining trend from 2016 until 2017 and just a small change from 2018 until 2020 with tiny increase and decreases. In 2016, which is the highest cost of sales, is due to direct labor and the overheads that's directly tied to production has increased, but they managed to cut it down. Transocean's Holding Berhad, on the other hand, is decreasing every year from 2016 to 2020. The reason is because the company resort into using machine and automation for most of the job. This can be seen in the increase of changes in the non-current assets percentage in vertical analysis. Besides, due to pandemic, it is harder for workers to work closely and travels to the respective location. That's all from me, thank you.
Total operating expenses. For Gunung Capital Berhad, the trend is inclining for 1 year, decline the next year, and climbs up again in 2019. In 2016, which is 100%, to 2020, which is 37.29%. For PDS Holding, the trend is similar with Gunung Capital Berhad with the incline and decline cycle. In 2016, which is 100% and dropped to 45.62% in 2020. For Transocean Berhad, an increase in operating expenses means less profit for a business. The highest percentage is on 2019, which is 130.64%, in 2016, which is 100%, and 2020, the company reported 112.23%. Earning or loss before interest and tax. Gunung Capital Berhad is in loss for 3 years straight. This means the company incurred a huge loss and made less profit for the years mentioned, from 100% in 2016 to negative 22.37% in 2020. For PDS Holding, the loss before interest and tax of this company has roughly increased from 2016 until 2018, and then in 2019 there is slightly decrease of losses before interest and tax. 100% in 2016 dropped to negative 549.94%. Transocean Company is quite interesting since it first decreases, then it slowly rises until it hit 301.32% of earning before tax and interest. However, right after its glory for 1 year, the earning dropped to negative 130.50%.
Last but not least is the earning or loss after interest and tax. So as we can see here, for Gunung Capital, the company is the most profitable in the year 2018, while PDS is the most profitable in the year 2019. As for the Transocean Holdings Berhad, it first decreases, then it slowly rises until 16.03%. However, it hit negative 669.67% in 2019. So what can we conclude here? So if the net income becomes negative, meaning there is a possibility that expenses are higher than sales.
Now we look at the recommendation to improve the weakness for Gunung Capital Berhad. The management of the group should proceed to accelerate development of its current mini hydropower project, as well as to expand and diversify into the energy solution provider business. The management prioritized on the expansion on the renewable energy segment through its mini hydropower project and to venture into solar energy sector.
Overall, the recommendation to improve weakness of PDZ Holding Berhad. So their income statement based on the horizontal analysis, they are unable to generate profit and they create net losses. In this case, the recommendation is they need to increase sales and give extra effort to implement marketing strategy of the company. For example, by promoting their business, improve business, and make more investment to their company to make people interested to use their services. In recent, PDZ Holdings Berhad has signed a memorandum of understanding with Protef Asia to enter the EU medical and military rubber glove market. So there's a possibility for PDZ overcome their losses by this new investment. Thank you.
The first improvement that can be considered is for the company to invest in search engine optimization. How this works is whenever someone searches for transportation and logistic company in Google, Transocean website or company will pop up first. So naturally, we will click the first option and this will give Transocean the market exposure. Next is to provide varieties of services compared to other competitors. Transocean can create new services like providing bundle services that include things like inventory management or inbound shipping as a comprehensive one-piece package and create a real value proposition. So that is all from us. Thank you very much for listening. Assalamualaikum.